the structure of the mortgage has to be done properly and correctly right from the get-go. A portion of the mortgage is a standard mortgage, but it's also tied to a home equity line of credit. As you pay down the mortgage more, then the credit limit of the home line of credit increases. Why don't I pay the $50,000 into my home and then draw it out as a line of credit?
Today, our guest is Mr. John Lee, the owner and the founder of Arise Mortgages. He achieved his business degree from SFU, and he has been in the mortgage industry for 8 years now. He helps clients get mortgages for residential and commercial use. In addition, he's a proud supporter of Compassion Canada, a nonprofit organization that releases children from poverty. So, without further ado, join me in welcoming our next guest, John Lee from Arise Mortgages. John, welcome to the podcast, and I want to thank you for taking time today from your busy schedule to answer our questions for our viewers. Now, being a mortgage broker for 8 years now, right? Why would a person who's looking into buying or refinancing come to a mortgage broker, and why wouldn't they go to like a bank mortgage advisor? Like, what's the difference between like a mortgage broker and a bank mortgage advisor?
Yeah, great question. Thanks, Ravi, for having me here. It's a pleasure to chat with you and to share just knowledge about mortgages. There's been so many changes, and it can be a daunting process for lots of people.
Yes.
So I'm happy to share information and answer your questions. So yeah, first question, now what's the difference between a mortgage broker and bank? So both ways are actually great. Those are generally the two ways for someone to get a mortgage. One way, going through a bank and going through a mortgage broker, the approach is pretty much the same. You'll have to see someone, sit down, talk to someone, and analyze what the situation is.
Mm-hmm.
And then through that, then they'll be able to figure out, okay, what kind of documents you need and how to structure the mortgage and things like that. Now, the only difference is that if someone was to go to a bank, then after the analysis, then they'll be able to figure out what that bank will be able to offer. Whereas with a mortgage broker, we have many different lenders behind us that we can fit your profile to ensure that we are maximizing your borrowing power, best terms, best rates, and just having the best mortgage product for your situation.
Yes.
So that's why I'm saying like both ways are fine, because some people, they have been banking with their banks ever since they're kids, and they have great income, great credit, and bank loves them. There shouldn't be any issues with qualifying. But not all Canadians are like that. There are some who don't have a relationship with their bank. There are some where their income might not be as straightforward, or there are some wrinkles in their credit bureau or just their history where banks will look at it and be like, I don't know, right?
Yeah.
But that may be just one bank. Not to say other banks may feel like that's going to be an issue. So with a mortgage broker, it just kind of cuts down on the time versus someone going to one bank and then they have to go to another bank, sit down again, repeat the story. And after 2 or 3 times where the bank's like, no, that's not going to work, it might be really discouraging. And I've had clients where they'll come to me, I'll analyze it, and I'll be like, yeah, looks like we have a deal. And they're like, what? What are you talking about? No, I spent like 3 weekends talking to different banks, and I've just been saying no. And after 30 minutes to 45 minutes talk, you're saying we can do it? It's like, yeah, because I know how to structure it. And I know what type of profile different banks are okay with, and then we'll just place you with that.
Mm-hmm.
So there's that aspect.
Yeah.
Other aspects that's kind of outside of the products and the qualifying would be the service. For mortgage brokers, we're different from most of the bank employees. I know some bank employees, they are commission based, but most of them are salary based. So for us mortgage brokers, we're all commission based. So we really want to earn your business, and not
Yes.
just the client's business, but their clients' referrals in the future.
Yes.
Kind of like your role as well, right? So
Correct.
so that expectation is really high because we don't get paid until we get the job done.
John. Yeah.
And in order for us to make this a successful career, we need to ensure that we have referrals, people are happy, to ensure that we continue on with this role. And how do we do that? Yes, one is service, but it's also the knowledge as well.
Yes.
It's not just like, at least for my approach, it's not just, oh, we'll just get you a mortgage. Well, no, a mortgage can drastically change someone's finances.
Yes.
From no debt to all of a sudden it's like, oh, you have 500,000 debt now, or 1 million.
Yeah.
And that change plays a big part on the whole financial planning process.
Mm-hmm.
So just like even like getting married, like that's a big life change. So with that, then I also want to make sure I'm not just giving debt to people. We also want to make sure that there are also other aspects of the financial planning that is also taken care of, such as taxes. We've got also making sure insurance,
Yes.
to ensure that if something were to happen to a client, then insurance can also kick in to make sure that the
That's
family
right.
is protected.
That's right.
Yeah.
That's right. So I think one of the benefits I see is I don't have to go to 5 banks, tell them my story. I just come to you. I tell you my situation, and now you understand my situation, and you go to like 50 institutes to figure out, okay, which one best fits my needs.
Exactly.
Right?
Yeah, it just
Excellent.
cuts down the process a lot, and everyone's really busy.
Yes.
And honestly, no one really wants a mortgage.
No.
They want that new home.
Yes.
They just need a mortgage as the vehicle to get them to that
Correct.
purchase. So most of the time, clients would prefer to spend more time to find their dream home
Mm-hmm.
versus spending all this time getting documents and running numbers. Like
Mm-hmm.
that's the boring stuff. Leave that to mortgage brokers and myself.
Yeah.
The fun part is to pick the dream home and
Mm-hmm.
to go viewings with you and to secure it.
Correct. Now, you spoke about structuring the deal. Can you talk a bit about that and the importance on how mortgage brokers, mortgage advisors structure deals, and why is that important to have the right mortgage advisor, mortgage broker on your side who knows how to do this?
Yeah. So for most people, they'll just think about rates. When it's mortgage rate. And banks know that. So you'll notice that when they do the advertisements, it's just like, bank is offering this rate.
Yeah.
Now, banks, they have done this for many, many years, and they make money different ways from a mortgage. One way is through the rate, which is what you pay for the term of the mortgage.
Correct.
But what people don't talk about is the full cost of having a mortgage. What you may not know is that they have statistics of how long people actually keep their mortgage for.
Mm.
And what people don't know is that people tend to pay out their mortgage, usually through selling their place, around 3.5 years into the mortgage.
Mm-hmm.
But what they sell usually is the 5-year fix.
Yes.
When you see advertising, it's 5-year fix. Why? Because that is the largest premium that they'll get if they're able to sell that product. Oh, what are you talking about? Usually 5-year fix that they give you a really nice rate. Yes, but the penalty is not that nice.
That's right.
And they don't advertise, oh, we have the best, lowest penalty. People don't even know there's a penalty because they're always thinking about rate at the time, at the beginning, the front cost, but no one talks about the end cost. And that's where banks also make a huge amount from the mortgage. So that's why when I do a consultation, yes, I can, if you want the best rate, I can get you a best rate. But that doesn't mean your cost for this entire transaction would be the lowest.
Yes.
So that's why there are actually most times that maybe the lowest rate may not be the best option. It could be a certain lender that may allow you to pay off the mortgage sooner, and then therefore, you'll in total the interest cost might be lower. So that's the analysis that I would go through in the consultation. Why you're buying it, what's the goal, and so on. And also, like I said, different banks will allow you to pay down your mortgage. A certain percentage. So it's usually starts with, say, like maybe 10% of the outstanding balance you can pay every single year. Some banks will do 20%.
20%. Yes.
And that's huge. That's almost double.
Yes.
And so for someone who expects to receive inheritance, bonus, a lump sum of money, that can drastically reduce the interest costs because you have the money already. So if you don't need to borrow it, you just put it into the principal, and then your interest costs will go down. Right. So that's one reason to reduce the total interest costs. And another would be future proofing. So if you're buying a place now, and then your plan maybe is to perhaps buy investment property, well, how can we maybe like hit two birds with one stone? Do this one transaction, but also future proof your plan for your second property.
That's right.
Right. So there are different mortgage products that would allow you to be able to secure the property with a mortgage, but then perhaps have a facility that's set up so that you can use that for the future to put a down payment on your future, say, rental property. Without going through the hassle of requalifying. So lots of things to talk about in terms of like structuring. Really depends on a client. But I guess what I'm trying to say is it's much more than just how much can I get, what's the rate. And that's it.
So I was calculating this for a client of mine, and we were looking at how we can pay down their mortgage and in next 5 years. Right. And we were just doing the numbers. And if they pay $70,000 every year towards their mortgage and we turn their monthly into weekly and accelerate, like pay more weekly. And if they were to pay that mortgage off in 5 years, they would save about $500,000 in interest. So that $700,000 property in the lifetime of the mortgage is actually costing you almost like 1.2. If you carry on that mortgage for that many years. But that's just mind-boggling, like how much money we throw towards interest payments. And I think that education you give to your clients on how to pay off your mortgage faster, I think is valuable, very valuable.
Especially now, like there are lots of like calculators that we can run, different scenarios that will show exactly, by end of the term or end of the amortization, like how much they'll cost. And this has come in quite handy and also very important because interest rate has gone up so much. Back a few years ago, no one was even thinking about paying down the mortgage because their interest rate was so low. It's like almost free money. So why do I want to pay it down? But once it hit like around, say, 6%, people are, okay, well, I can either use this money to get a GIC or invest it, or I could pay down my mortgage and save 6%, for example.
Yes.
Then people are now spending that time to consider paying down the mortgage faster, so then they can save on the interest costs.
Yes, yes. So I wanted to also talk about like what you mentioned, like strategizing around, like you have one property now. How do you get your second property, right? And there's a terminology called Smith maneuver.
Yes.
And I know we have kind of talked about that, and I use it with my property as well. So instead of taking my savings and putting that money into the investment property, I actually pay down my principal.
Yeah.
Right. So the interest, the principal amount comes down. I'm paying off my personal home like quickly, where that 40,000 now has come available in my line of credit.
Yeah.
Now I use that to buy my investment property.
Yeah.
Right. So I know in US, the interest you pay on your home, you can write that off. In Canada, you cannot. Right. So like knowing Smith maneuver, like how could, like, have you set things up? Like, how could you set this up for somebody who says, look, I own my home. I have quite a bit of equity in my home, and I have some savings as well, but I want to buy that property. Like, how can you help people set this up properly so they don't get in trouble with the CRA department, right?
So I was mentioning about future proofing
Yes.
before this, and this is exactly it. So if someone were to want to utilize the Smith maneuver, the structure of the mortgage has to be done properly and correctly right from the get-go.
Correct.
And how do we structure it? And it is through a hybrid mortgage. So where a portion of the mortgage is a standard mortgage, but it's also tied to a home equity line of credit. As you pay down the mortgage more, then the credit limit of the home line of credit increases. So if someone, say for yourself, you were saying, okay, well, I have 50,000, I can just go 50,000 and then put it as a down payment, right? Yes, that's one way to do it. But you're saying, okay, well, why don't I pay the 50,000 into my home?
Yes.
And then draw it out as a line of credit. Oh, why would someone do that? That's so weird. Well, it's first off, it's because it's set up as a hybrid mortgage. So you know that if you put that $50,000 into the mortgage, it's not like you're putting it into a black hole where you will never see it again until you sell the property.
Yes.
It gets transferred right into the home equity line of credit. Right? Yeah. Only if it is set up properly in the first place.
Yes.
So then now, this $50,000, then you draw out from the home line of credit. Well, why do we want to do that? Because then now we want to show the CRA that you are using this facility, this portion of the mortgage.
The HELOC.
Yes, for investment purposes. And it's because it's investment purposes.
Yes.
Then you can write off the interest.
On the HELOC part.
On the HELOC part.
Correct.
The interest costs of the mortgage.
Correct.
Whereas if it's just your principal home, you can't write that off because for your principal home, if you sell in the future, it's actually tax-free. So
that's right.
Because it's tax-free, you can't write off anything. So, but for investment properties, there's potential capital gains.
Yes.
And other things like rental income that you can write off. So that's why we want to ensure that we use that home equity line of credit, create some expenses.
Yes.
So then we could write off the potential income coming from the investment property. Yeah. Now, well, then what? That's great. well, then the idea is that you are using that portion, $50,000, to invest, and hopefully you do a great job investing, and then now it becomes, say, 70,000 or 80,000. Then you use that money that you've earned, then you put it back into your home, you pay down the mortgage, and then you do it all over again, right? You put it back in, and you have more on the home equity line of credit.
Yes.
Then you pick another investment. So, with that structure, then, again, back to mortgage rates. Is the mortgage rate really that important? Yes, of course it's important, but really it's the strategy and the structure of the mortgage that's even more important.
Yes.
Because if the bank is allowing you to pay down your mortgage percent faster with a higher percentage that you can put in, that allows you to save more interest.
Yes.
Then you can draw it back out and then invest, and then with the earnings, then you have to put it back in. So really, it's the cost is not just the rate now; it's the overall financial picture of what the mortgage is like, and you may end up actually paying a lot less than what the contract rate was, because of the amount of money that you have put into the mortgage.
And you're right. A lot of people get caught up on the rate when they should be understanding the other parts of the mortgage.
Yeah.
And how does that affect them in future? Like you said, hefty penalties for canceling like a 5-year mortgage, right? Yeah. So talking about mortgage products, it's not just like, oh, I want to get a mortgage, I want to buy a house, I want to get a mortgage. But there's different mortgage products that many financial institutes have. And let's say I have 20% down, I buy an old house, I have a line of credit that I use to renovate my house, right? Can I somehow incorporate that cost that I incurred to renovate my place after I bought to incorporate that cost into my mortgage? And how would that work? And what is that product called? I just want viewers to understand that, look, it's not just mortgage.
Yeah.
There's different types of mortgages, right? Yeah. So can you kind of explain the viewers how that mortgage works?
Yeah. So
please?
This type of mortgage is called Purchase Plus mortgage.
Purchase Plus.
And what that is that it allows you to factor in the completed value after renovations as part of the property value. So then you can take, say 80% of the higher value now. But see, the thing is, the value is not in the property yet because you haven't done the renovation.
Yes.
So what happened is that during the application, we will disclose that the plan is to renovate, and the lender will be, okay, great, you're renovating, what are you going to be doing? And I want to see a breakdown of the costs and the contract with the contractor.
The receipts?
Well, you don't have the receipts yet, the invoice,
right.
or the budgeting in the beginning. And say the renovation is going to be $100,000 and your property is $800,000. And if we're going to add in $100,000 into the renovation, then the lender will be like, okay, I'm just going to pretend your property is $900,000 and we're going to qualify you 80% based on the $900,000. But because you haven't done the renovations yet, we're going to approve you first, but we're going to hold back this extra amount until you're done. Then we're going to release it.
And how do they know if I've done my renos? I guess the appraiser.
Yes, so appraiser will have to be ordered, and they will come
before and after.
Before it would just be to determine what the value is as is.
As is.
But the one afterwards, it's not we call it a progress report. It's not really, they're not really there to determine the value. They're just there just to determine whether the work is completed.
Got it.
And they'll just, so how would they know is they'll ask for that breakdown again of the cost and what they're doing. And they're going to inspect. And if it's all done, then they'll say 100%. They'll give it to lender, and lender will have that on file and then release the remaining funds.
Okay. So the person can pay off their line of credit now.
Exactly.
And that cost has been incorporated into the mortgage.
Yes.
Right?
So one thing is that the renovations are usually not structural. So if you want to do your kitchen, bathroom, flooring, painting, that's all great.
Yes.
If you're looking to like redo your foundation, because
lift the foundation.
Yeah, that probably not.
House, yeah. Okay, that's not. Yeah.
Yeah.
Okay. All right. Now, in terms of buying your second property, like what would you advise to people when they have a property and they want to buy another property and another property? Like they want to accumulate properties, because that's how you create wealth, right?
Yes.
You accumulate properties and you keep on renting them out. So how do, like you've heard of people that qualify for multiple mortgages, and you think, well, here I am, I qualified for one and I had such a hard time, and how do I qualify for my next one?
Yeah.
So what would you advise people who are thinking about accumulating properties? What kind of things can they do?
So the very first step is to purchase your own home.
Yes.
But not maximize the ability to purchase. So most of the time, especially in Vancouver, and I get it because in Vancouver prices are so high.
Yes.
People will be like, come to me and be like, John, how much can I afford? I'm like, 1 million. Okay. And then they go, I'm going to buy 1 million.
Yeah.
So, which is fine if they don't want to create a real estate portfolio. But if their plan is to buy multiple, it may be wise to maybe not max out that 1 million just all for yourself. Maybe wise to maybe start off with a 1 or 2 bedroom, and then maybe go for something in the ballpark of like 600,000 to 700,000. So then they're not really maximizing their borrowing power. So then they are able to utilize what's kind of left over for a potential second property. So really that very first step, again, is very important.
Yeah.
Because if they decide to buy and maximize, it may take them a little bit longer to fulfill that goal. Maybe at least 5 years, more like 10 years, because lots of things needs to happen. One, their income has to go up, and wages, it's capped usually. It only goes up a certain percentage, unless maybe they like jump different places and they get promoted. But if they stay the same, maybe 4 or 5% increase per year. And then they also need to have certain equity as well in their existing property.
Yes.
To potentially look at down payment and so on. So that needs to be planned in advance. So if they do decide to take my advice and they're okay with it, then they may be able to purchase that second property much sooner. And why do you want to do that is because, like you said, you can build wealth faster using real estate. And the reason is because you can put down maybe $50,000 to $100,000 on a property, but the return, the percentage of the return is not on the money that you put in, which is maybe 50 or 100,000. It's on the value of the property, which is 500,000.
Correct.
So 10% of 500,000 is way more than 10% of 50,000, right?
Correct.
And so then you are able to have your own home, which is hopefully going up in value, and then also another property that's also going up in value for you. And without having enough cash to buy two properties in full, you're using other people's money to help leverage to get these two assets. So that's one way. Second is to also ensure that you are incorporating the potential rental income on the rental property. So like I said, the employment income can only go up so much.
Yeah.
But if we're going to purchase a rental property, even though your desire is to rent it out, but you don't have a tenant yet, we could authorize an appraiser to appraise what the potential rental income would be.
Like a market rent.
Yeah, market rent. And the bank will accept that as the income. So we could then boost up your borrowing power, even though you haven't rented out yet.
Yes.
So that definitely helps you qualify more. And the third thing, what I really like is if you really decide to want to cash out, having two properties is much better than only just having one.
Yes.
Because if you want to cash it out, it wouldn't affect your daily life.
Yeah.
You will still have a place to live and you'll still receive money because you have two properties. Whereas some people, if they make the mistake of purchasing the maximum from the beginning, they need to sell, which they have to move, and then they may need to move further away or maybe downsize in order to have more money for the second property.
Yes.
So it's some people are okay with it, but for some, if they have a family already, it's really difficult, especially now you're kind of tied down into that neighborhood. Maybe kids are going to school.
Yes.
Your work is a certain area. So it makes it more challenging.
Yes, yes. So, okay, so let's say I've got my second property now. I want to get the third one.
Yeah.
And I've seen people go up to like 8, 9 properties.
Mm-hmm.
So what are they doing that the viewers can benefit from? Like what would you advise them if they want to not just buy their second, but they want to buy, like every year they want to buy one, right?
Mm-hmm.
So are there financial institutes that will lend differently when compared to other financial institutes that you guys deal with?
Mm-hmm.
The lenders, I mean?
Yeah, it does become a lot trickier.
Yes.
Again, just because in Vancouver, property prices are quite high. People are happy if they can only just buy one.
Yeah.
What I find is that, for those who are high income earners and they invest well and they're just more sophisticated when it comes to finances, then they get it and they are able to have that ability to qualify for more mortgage and leverage more. So that process would be the same, whether you're buying a second, third, or fourth. There are some restrictions on some banks where they cap it at 5 properties. Then banks will want you to qualify a different way, more like they'll see it more as a business now versus you as a personal name. So then it's a different department, probably commercial lending in that case. Then they're able to allow you to have a larger real estate portfolio. But say you're third and fourth and you really want to, but you can't because your income is just so limited. We've maxed out already on the rental income. And maybe some properties aren't even cash flowing because we're in Vancouver. We're just kind of really just banking on the capital gain.
These high rates.
Yeah.
Yes.
Someone asked me, like, what's the best case scenario when it comes to rental properties? Best case scenario is if you are collecting rent and it covers the mortgage payment but then you still need to fork out maybe the strata fees and the property tax and maybe utilities, insurance, and so on.
Yes.
So that is actually a best case scenario. So many of these properties portfolio might not cash flow, which makes it even more difficult to qualify.
Yeah.
So what's the solution? Bring in more partners. So it's very difficult to try to increase your own income, but it's very easy to bring in someone else who makes 100,000 or something, who can partner up with you and then buy a rental property with you. However you guys want to like set it up, maybe one person puts in the down payment, one person comes in to help out with the qualifying. It's really up to you, but I've seen more and more partnerships when it comes to investing in real estate for the purpose of qualifying for a mortgage.
And what is the difference like between buying a property under your personal name or setting up a holding company and buying under a holding company? And how does the mortgage work with the holding company?
Yeah. So qualifying would be very similar. It's just more paperwork because now under a holding company, it's another entity. So we just need to ensure this entity is owned, who is owned by. The process is the same because bank, when they qualify you, really the holding company is more of a shell, just a name that they're going to put the property under, which is really worthless. So what they do is they request for a personal guarantee. So you can't just hide behind this corporation and bankrupt it. They will still require the people who owns the company to offer their securities as well. So structuring of it is different. Process will be very much the same, besides more documents for the holding company. Big difference would be taxation and then liability.
Correct.
So first, tax.
That's the accountant question.
That's the accountant question.
Yeah.
But for personal, you can play around with it because it just comes down to how much you make in general, and then what tax bracket you're in, and then we just add on the income from the investment. So if you're a lower tax bracket and you receive rental income, tax might not be too bad. However, for a holding company, government doesn't care there is no tax bracket. It assumes that you are at the highest tax bracket, which means you're getting taxed 50%. So that is a big difference. So if that is the case and you have a good accountant, you will want your holding company to make $0.
Yes.
And how do we do that? Well,
that's
accounting, but you have to just write off as much as possible.
Yes.
Interest, any expenses to write off the rental income.
Yes.
But eventually, CRA has their way to get their money, and that is through the capital gain.
Yeah.
So eventually you want to sell it. Whether you make 10,000, 200,000, 1 million, it will still be at the highest tax bracket, which is 50%.
Yeah.
So just make sure you coordinate with an accountant to kind of strategically see how you can minimize the tax as much as possible.
Correct.
Number two, I mentioned, is the liability.
Yeah.
So it is more worthwhile to put it under a holding company if you're buying more of a commercial property. So say you're buying a restaurant, including like the building and all that. Well, why? It's because the potential for someone to sue you is much higher. So if it's a restaurant, someone can slip and fall. Someone could have food poisoning or be really, really sick. And the person who's involved will sue everyone.
Yes.
even though it's not your fault.
Yeah,
They'll
yeah.
sue the restaurant, and then they'll sue maybe the government for not like clearing the snow, and then also sue the landlord as well.
Yes. Yes.
So in that case, you want to have a separate entity to protect you from your own personal assets. So this is very different. So, like I said before, bank will require personal guarantee for the financing.
Yeah.
But then in this case, you do have a protection, liability protection, because it is a separate entity. So they'll sue the company, corporation, but they can't go after you personally. So that kind of creates a barrier.
Okay.
But I mean, that's commercial. It could be the same thing for residential as well, but not as often because people just go there, sleep, cook, right? And then worst thing usually for residential would be like fire and flood, which would already have insurance in place to protect
So when I get this mortgage under a holding company, and you said I personally need to
personal guarantee.
Guarantee it, right? Will this transaction, even though it's under corporation, under holding company, will it because I'm guaranteeing it, will it show up on my credit bureau?
It will not show up on your credit bureau.
Okay.
Yeah. So there are some strategies involved because even though sometimes if it doesn't show up on the credit bureau, if the commercial mortgage is with that bank and you're going to apply a new mortgage with that particular bank,
They know.
They'll know, even though it doesn't show up on your credit bureau. But other banks, if they pull your credit, they will not see a mortgage.
And and would I pay a higher rate because it's under a company, or do I get the best rate?
So it depends. So I mentioned the 5 properties. So if it's like 5 and less, you will still be considered like borrowing as an individual. So you would be getting the same rates as with someone purchasing as an individual. But 5 or more, then it becomes commercial lending. Then those rates tend to be slightly higher.
Okay. And how about qualifying for those mortgages then after 5?
Qualifying will be a lot different.
Okay.
So good question. Because stress tests is lots of times for people who are buying individually.
Yes.
But when it comes to commercial mortgages, that doesn't necessarily fall under the stress test rules.
Oh.
So you could qualify under the contract rate.
Oh.
Yeah. So you could borrow more.
Okay.
And hence then you could, create a larger
portfolio,
real estate portfolio.
Okay. Yeah. So let's say if I have some under my name, some under my corporation, my holding company, can I combine them both and I say I have 5? Or it has to be 5 under my personal name and it cannot be combination?
No, it doesn't have to be where you only qualify for the commercial side only after 5. Even on your second property, if you have a holding company, you can still go to commercial side as well.
Okay.
But what people would want to try is the individual side first, if they can qualify, because the rates are cheaper.
Yes.
So if they can go through that route, they'll try to maximize the individual route first. Then they would go to the commercial side.
Okay. So going away from the investment side now and going towards homeowners who already have a mortgage. Like I have people who bought condos, they want to upgrade to a townhome. Yeah. The folks who bought townhomes, they want to upgrade to a detached house. Yeah. And there's always that dilemma. Do I buy first or do I sell first? Because if I buy first and I can't sell my place, then I'm stuck with 2 mortgages.
Yeah.
Right. And I know, going back to like products, right? As a advisor, like what what product is that where you can actually give them the mortgage of their new home while they still hold this mortgage, because the completions they don't match, right?
Yeah.
Like they bought a place, they have to complete now, and then after 2 months, the sale of their home completes. But now for that next 2 months, they have the mortgage on this new home
Mm-hmm.
and their existing mortgage.
Mm-hmm.
And now what? Like what how do you structure something like that so the client has a peace of mind?
Yeah. So it is called what you're mentioning is called bridge financing.
Yes.
Basically, when we would need to use that is the purchase completion date is before the completion date for the sale.
Yes.
Um, Now there are as much as we can do that, we usually clients they prefer not to because yes, the facility is in place, but it is still quite a lot to understand the whole entire process.
Yeah.
And but in order for us to utilize bridge financing, we do need a firm sale on the existing property
Yes.
in order to qualify for it, because that's the firm sale gives more confidence from the lender to
Yeah.
be like, okay, I know it haven't sold yet, but because of this, then we'll take your word for it. So that's a really big piece of the puzzle to get. You can't get bridge financing and us telling the bank like, oh, we will sell it in the future. Trust us. The bank's
No.
like, nope, I don't think so. What if you can't? And now we're borrowing you way too much money than we're comfortable with.
Correct.
So that is possible, and the buy and sell, the dates in between, depends on the bank. It's usually between 90 to 120 days.
Mm-hmm.
Most of the time, clients will want this period to be as short as possible.
Yeah.
The reason is because bridge financing is available, but banks know because it's short term
Yeah.
and you have to have it, they're going to charge you a pretty high interest. We're talking about prime plus 5%.
What?
Yeah. So it's definitely not cheap.
Wow.
Treat it as if the time that you are still holding the two properties, you're like paying rent, like Vancouver rent, to hold this property. That's kind of how I, after doing the calculation and explaining to the clients,
Yeah.
because it's either that or you sell first, and then you don't know when to buy.
Yeah.
So then you find a place to rent.
So go through the hassle of moving once
again. Yes.
and moving again.
Yes,
right? Twice.
Exactly.
And paying rent.
So that's kind of the justification and the idea of it. So yes, you still need to pay, but it's actually not as bad as the other option because you have to keep moving and also store all your stuff in the storage room. And that can add up to the cost as well.
So in my 20 years of practicing real estate, I've had that happen maybe once or twice.
Okay.
But for most of my clients, what we have done is sold their place successfully and then help them find something and have the dates kind of match in between where they complete on their sale, they get the money, and now they complete on their purchase, and then they move out, and then they give possession for the place, right?
Exactly.
So there's a gap between their completion date and possession date. Like there's like 5 days gap.
Yeah. Like
and that works the best.
That works the best. That's the ideal situation. And yeah, when markets are more balanced, I think that is more doable. But there are times, Vancouver market can be crazy, and everyone's doing the same thing, trying to buy like
Yeah.
sell and then buy. So yes, so yeah,
Yes.
it's if the timing works, that's perfect. But sometimes it doesn't, and there's bridge financing
And
that's
do you know what? It
available.
comes down to the market.
Yes.
Like right now, if you can pick up a good buy, like you find a property that is a great deal,
Mhm.
and you know you have to purchase it, well, you have to purchase it.
Yeah.
But now you have to strategize around how do you put your home on the market. You have to be reasonable with price, and then you have to look at many factors like, are you putting your property up in the middle of the winter or like the hot spring market, right?
Yeah.
So we've done this for clients where we've picked up properties in November
Mhm.
and then put their properties up on sale in February, March, and sold it for the best price, and then they move in April,
Yes.
right? And that has worked really well.
Mhm.
So listen, I want to thank you so much for taking time out and talking to us today and sharing your knowledge. It was so much fun talking to you and learning from you and your 8 years of experience on how different mortgage products work and how Smith Maneuver works. And to our viewers, if you guys are thinking of getting in contact with John, the link, the John's contact info is in the description below of this YouTube video. So do contact him and pick his brains on how do mortgage products work, and do use him for any of your mortgage needs. Thank you.
No, thanks for
Thanks so
having me,
much for coming
Ravi.
in. All
Thank
right.
you. It
Thank you.
was a pleasure.
Thank you.